SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF-BAFFI Bocconi e-lecture on artificial intelligence in economic and financial policymaking. AI has emerged as a transformative technology across a range of activities. Most expect that it will trigger significant changes in economic structure and financial systems. Being a general purpose technology with potential for rapid innovation, AI calls for careful management and proactive policies. Governments have three roles to play in AI development. First, AI enablement, for instance, R&D, education, infrastructure, financing. Second, the use of AI in government itself. And third, the enactment of laws and regulations for the private sector to ensure that AI supports economic objectives like growth, stability, well-being, equity. The speed of innovation and adoption of AI, its impact on the economy, labor markets, finance, and sustainability may well be rapid. AI poses several urgent questions for policymakers. How might scaling affect market concentration? What are trade-offs between proprietary and open source systems? How to govern data availability? And how about the sustainability of AI given high capital and particularly energy costs? Policymakers and regulators need to remain vigilant to AI developments and be prepared to adopt policy flexibly. Opinions on the best approaches diverge. G7 governments, as we will hear, and central banks prefer different approaches depending on culture, legal systems, national priorities, and also perceptions of risk or risk-taking behavior. We are privileged to have three outstanding speakers with us here today. To start with, Anton Korinek, professor at the Department of Economics and Darden School of Business at the University of Virginia, and senior scientist at the Complexity Science Hub in Vienna, will present key findings from the G7 report on AI in economic and financial policymaking. Following this, Iñaki Aldasoro, principal economist at the Monetary and Economics Department's the Financial Stability Policy Division of the BIS, will present AI use cases for central banks. Then, Risto Uuk, head of EU Policy and Research at Future of Life Institute and at KU Leuven and Stanford Digital Economy Lab, will offer his thinking on how AI will shape our economies and on which paths this will take. Without further ado, over to you, dear Anton.
Thank you very much, Ernest, for inviting me to give this presentation. This presentation is in part based on the findings of a high-level panel of experts report on AI in economic and financial policy making that was established by a G7 mandate. The panel was chaired by Dr. Luis Videgaray, but I'm speaking in a personal capacity. I'm delivering a research lecture to you today, drawing both on the insights of the report and on my own research, and the views do not represent those of the G7 or of the other panel members. Let me start by asking, why does AI matter for economic and financial policy making? Well, first, AI is a general purpose technology and is by many expected to be transformative. Secondly, we have seen accelerating progress in AI. We have seen the pace at which new models are being released, and also by some measures, the pace at which they are getting better increase. And as Ernest already foreshadowed, that raises three key questions for governments, three roles that they can play in this age of accelerating AI progress. One is to look at how can we enable positive uses of AI. So that involves, for example, research and development, education, infrastructure, and also financing. 2, governments can also use AI. Let me maybe start by focusing on the uncertainty that policymakers will face. So the first uncertainties are stemming from the scaling of AI. Over the past decade or so, we have observed that AI systems become predictably better as we throw more computational power at them. So the big question is, will AI continue to improve in performance as we create better and better systems?
Yes.
Will AI continue to improve as we throw more and more computational power, or will there be ceilings or walls that will be hit at some point? So since 2022, there has been rapid progress, right? And the AI labs, the leading labs like OpenAI, Anthropic, Google DeepMind, are declaring that one of their goals is to develop artificial general intelligence, which would be AI systems that can perform essentially all economically valuable cognitive tasks. But yeah, how will this actually play out? So I show you a graph here which depicts how much the computational power thrown at AI systems has been growing for the past 15 years. This is on a logarithmic scale, so it means you see that there is a kind of linear regression line through all these dots, and that captures that there's actually exponential progress at a kind of mind-blowing pace. The amount of computational power devised to train our leading AI systems has grown by a factor of 4.5x per year, every single year for the past 15 years. And there's no end in sight to that. Now, scaling laws have also told us that we should expect the intelligence, broadly speaking, of the resulting model to be a predictable function of the amount of compute devised to train them. And many of you may have heard last fall, there were some concerns whether scaling of AI is going to continue in the way that it was expected. Some people said, well, we may be hitting a wall. Well, it turns out, and I speak this now with the benefit of hindsight, this is something we didn't quite know yet when the report came out, or at least we didn't quite know yet how significant it was going to be. There was a new paradigm of AI, which was the emergence of so-called reasoning models. AI models that proverbially think before they respond, and that have become an order of magnitude better at things like math or coding. And it turns out that this new paradigm of reasoning models has in fact given rise to two new scaling paradigms. So now scaling helps us not only when we train an initial AI base model, as it's called, but we can also scale by letting the AI think for longer or train the AI how to think better. And these two new dimensions of scaling have been very important, for example, in OpenAI's recent models, but essentially in the offerings of all the big frontier AI labs, including, for example, DeepSeek. And as these new paradigms are only starting to be explored, we have seen even more rapid progress, I would say, in the last few months than we have seen, for example, during a comparable time frame a year ago. So scaling is not dead, but in fact, we have two new scaling paradigms. Now, a second thing that is new in 2025 is the rise of AI agents. So what are AI agents? they are essentially systems that can autonomously pursue goals. And they do that using three tricks, so to say. The first one is they start by laying out a strategic plan. The second one is they have the ability to keep longer-term memories, to chain together multiple actions. And the third one is they can also employ external tools. For example, they can search the web, they can browse the internet, they can click on things on the internet, they can call up other AI tools, and so on. And that makes them much more capable than the systems that we had a year ago. So this builds on the greater reliability of AI models in the longer context windows and faster speeds, and it is the main focus of the AI buzz, so to say, in 2025. Now, there are also uncertainties when it comes to the market structure of AI. Right now, we are seeing fierce competition among the top model providers, but the big question is, will continued scaling the need to use more and more computational resources lead to natural monopolies or perhaps market tipping, like what we have observed in the context of social media? There's also the question, will proprietary models, essentially models that only run on the computer servers of the big labs, be continuing to be the top of the pack, or will open source models continue to advance and allow for a very competitive alternative to the proprietary models? So in some sense, the big benefit of open source models is that anybody can download them and run them on their own computer, which makes for maximum information security. It also allows researchers to tinker with these models. The big downside, and I see potential downside going forward, is that as these models become more powerful, having them open source such that anybody in the world can download them and use them for potentially nefarious purposes may present growing security risks. And speaking about market structure, I think one thing we have to keep a close focus on is that there is significant concentration in the production of AI chips right now, even though we have all this competition in the production of AI models. Okay, so in the face of all these uncertainties, both technological and market structure-wise, one of the approaches that we recommend in the panel report is to engage in scenario planning. And there are three scenarios that we propose as useful for economic policymakers. We call the first one the conventional wisdom scenario. That would entail gradual progress in AI, limited disruption. AI would be kind of like the internet boom, something that creates a new paradigm, something that increases our productivity, that changes the way that we interact with data, that we interact with computers, but that does not fundamentally change our world. However, there's also the possibility that AI will turn into something bigger, that it will turn into artificial general intelligence, which would be an AI system that has human-like capabilities across the range of what our brains can do. And so the next two scenarios that we propose, we call them the intermediate AGI scenario, the accelerated AGI scenario, evaluate what would happen if we do reach AGI. And the first one, if we reach it within 20 years progressively. The second one, the accelerated AGI scenario, if we reach it within the next 2 to 5 years, which would entail much more rapid transformation. So considering those three scenarios explicitly is something that I personally also perceive as extremely useful when we have to deal with this enormous degree of uncertainty created by AI. So let me now turn to the macroeconomic effects. First of all, innovation and growth. There are two main mechanisms through which continued advances in AI may increase innovation and growth. The first one is the automation of existing cognitive tasks, but the second one is that we accelerate the process of innovation, that we essentially accelerate research and development and also the rollout of new innovations, because AI can invent new things that were not amenable to our human inventions. Again, there are some key uncertainties. Nobody knows how fast progress will continue going forward. And nobody knows how long the adoption and diffusion lags will be. For prior general purpose technologies, it often took a decade or more until we could actually measure the effects of the technology in macroeconomic statistics. AI may be different in part because we don't need to buy new computer systems, we can just employ it on our existing infrastructure, and in part because as it becomes smarter and smarter, it can increasingly roll itself out. So I have compiled a bunch of different studies that project the impact of AI on economic growth. And you can see that the range between those different studies is enormous. It's like a factor of 20x between the most conservative prediction by Daron Acemoglu, who says AI will increase GDP by 0.07%. And then Goldman Sachs and also Martin Bailey, Eric Brynjolfsson, and I in the rightmost bar chart, we predict that even the current AI will have far greater effects on economic growth and innovation. Second macroeconomic topic, what are the labor market effects of AI? We know that in the past, new technologies have always had a large effect on labor markets, and there are many ways of splicing and dicing the economic effects of technology, but one is to focus on a productivity effect and on a displacement effect. And I'm sure AI will have both of these effects as well. The big question is how severe will these effects be? And I see we as economists, we know that the overall effect of technology on labor in the past 250 years has been very positive. In advanced economies, our standards of living are something like 20 times what they were 250 years ago. And that's all because of new technologies, because of technological progress. But I will also caution that it would be dangerous to just blindly extrapolate that and to say, oh, we know this has always held and therefore it will always continue. AGI could shift paradigms and lead to the demise of what I want to call the age of labor. Because in some sense you can say much of the history of the Industrial Revolution has been to displace physical work, and now we are on the road to displacing more and more cognitive work. And if it is true that AI systems will reach human levels of intelligence across the board, then that displacement may not leave very much for humans to remain in. And that could severely undermine labor markets. So this would have tremendous distributive effects and may in fact even require a new social contract. Here I'm showing you a simulation based on another paper of mine that was published by the IMF on scenario planning for an AGI future, which shows the effects of AI versus AGI, the artificial general intelligence that could perform all labor market tasks, on output in the left figure and on wages in the right figure. So the blue line is kind of the baseline if AI is just a regular technology, like let's say the internet, And the yellow and the red line would correspond to the baseline and accelerated HEI scenarios. So in a nutshell, HEI would make output go up far more significantly than what we have experienced in the past. But at the same time, as we come close to the point where machines can perform all labor market tasks, wages would first stagnate and then collapse. Because if a machine can do the same work that we humans can do, then the competitive wage of a human would be essentially bounded by the cost at which a machine can perform the same thing. So this may be a fundamental change from the effects of technology on labor in the past 250 years. Now, a third point that I think is very important because it offers lots of positive potential is the responsible use of AI by government authorities. I think there is enormous potential for both better and more efficient governance, but I should also say that there are lots of challenges. And in fact, one of the prime challenges that I perceive when speaking to government authorities is the challenge of making sure that the workforce is trained and is sufficiently encouraged to use AI systems. There's a lot of ill-informed skepticism, and a lot of people who are well-intentioned are facing bureaucratic impediments. There's also a need to build a safe infrastructure. But what I want to emphasize, and this is something that is not as obvious as the challenges that come, for example, from using AI responsibly and using it safely. But one of the biggest risks in my perspective is the risk of inaction, which could lead governments to fall behind while the private sector rapidly adopts AI systems and basically drowns government authorities in more and more AI-generated data. And if government authorities don't have the ability to keep up with that, it could significantly reduce our ability to govern, and it could lead to worse outcomes. Now, I should say I have also explored the use of generative AI in economic work specifically, and in fact I have a series of papers on how to use generative AI in economic research. I am writing an update for this paper that was originally published in the Journal of Economic Literature every half year. And right now I'm in the process of writing the fourth update that will be published in June. I think I'll have a working paper version in the next few weeks. If you are interested, you can sign up for these updates under the QR code that is given here on the left of the slide. So one of the last chapters of the report was on AI in finance. Currently, finance is in some ways at the forefront of adopting generative AI, aside, of course, from the technology sector. Financial institutions are engaging in massive investments to automate entire workflows through, for example, AI agents. And just like in government itself, that offers some opportunities, the opportunity to gain productivity, the opportunity, if we do it right, to reduce biases, to engage in better risk management. But of course, it could also be just the opposite if we don't do it right. We could increase biases, we could increase risk, and so on. So the challenge is to make sure that these AI systems are aligned and are facing human oversight, including by regulators. So, for example, one of the risks that I see in the financial sector is regulatory arbitrage and manipulation at large scale, driven by highly intelligent automated agents. And that's certainly something we want to forestall. So what are the financial stability implications? One of the risks, and I have to say at this point, we can only speculate because we have not seen the widespread rollout of the current generation of AI in the financial industry. But the risk that I think we want to be aware of because of our past experience is that we could automate financial instability. In some sense, you could say the first example of automated agents that created a financial crash was in 1987, when automated portfolio insurance led to the massive stock market crash back then. Well, today's AI agents are faster, by some measures more opaque, possibly more uniform, possibly more correlated. We don't have a lot of information on that, but we want to be careful in their adoption. And then a final point when it comes to financial sector is that AGI, if we reach that level of AI capabilities, may generate large redistributions, could lead to significant labor displacement, shifts in corporate revenues and tax revenues, because right now labor is the most important source of tax revenue for most governments. And it could also lead to rapid shifts in asset prices and exchange rates between different countries that differ in the speed of adopting AGI. And all of those redistributions and dislocations generate debt sustainability risks and default risks, both at the household level, at the firm level, but even at the governmental level. And in fact, we have explored these risks and many other considerations about AI in the financial sector in a EIS working paper last June, together with Inaki, who will be speaking after me. So let me come to the final point of my presentation, in which I want to review and summarize the policy recommendations given by the report. First, two general points. These policy recommendations need to be approached proactively, since AI is advancing so rapidly and transparently. But yeah, what are the more specific recommendations? The report recommends that we augment the AI expertise within governmental institutions, that we explore how AI capabilities can be used to enhance public institutions, that we establish AI procurement strategies. It also recommends to modernize government data management, to enhance AI cybersecurity. Security holes will be much easier to exploit when there are all these automated agents. It recommends to establish guidelines for AI in financial activities, and then also to monitor labor market impacts and prepare for the possibility of disruption. And finally, since this is kind of a global development and financial markets are inherently globally integrated, it would also be desirable to have cross-border cooperation on monitoring, especially the financial flows that, and how AI interacts with them. Now, one of what I think was the most useful tools in the report was that it recommends an AI policy preparedness matrix. So I mentioned before that there are 3 different scenarios that we advocated analyzing and paying close attention to. And there is a whole range of different policy tools. And the question is, how can our policy tools prepare for the different scenarios so that we can ultimately identify policies that work across the scenarios while also preserving policy optionality? So this policy preparedness matrix, it lists the tools in all the rows and the 3 scenarios in the 3 columns. I'll show you the full policy preparedness matrix, but the font here is a little bit smaller. And I think what is desirable is that every governmental institution evaluates how the different tools at its availability would perform and would affect these different scenarios, which ones are robust across scenarios, which ones we want to use in a contingent manner if we notice that AI is suddenly taking off rapidly, or we notice AI is hitting a ceiling and will develop more slowly going forward. I'll just read the major categories here. One category is investments in AI enablement. Another category, use of AI in government. A third one, other economic policy tools like competition and employment tools and so on. And then the fourth one is about how do we govern the rapidly advancing AI tools. And if you're interested, this matrix is given on page 70 of the high-level panel of experts report. So let me just conclude with some personal reflections. What do I view as the critical priorities? Having observed the advances in AI in the past couple of years, and having observed the speed up that has occurred in the last half year, in the last couple of months, I believe it is really critical to prepare for rapid technological change going forward, while acknowledging that there is a lot of uncertainty about it. I believe it's critical to build policy capacity, but also to preserve some flexibility while avoiding the harmful effects of AI, because ultimately AI is a technology that has the potential to deliver large benefits. And I think what we want to do is we want to ensure that these benefits are spread widely so that our populations at large will ultimately benefit from them. And let me just conclude with this slide of background readings. Thank you, and back to you, Ernest.
Thank you very much, Anton. You covered a lot of ground, really a lot of food for thought. Just to say, the report is linked on the website to this event. So if you want to consult page 70, then please click there. Now, it is now my pleasure to hand over to Iñaki Aldasoro, Principal Economist, Monetary Economic Department, Financial Stability Policy Division at the BIS. Over to you, Iñaki.
Thanks a lot. Can you confirm that you can see the slides?
Yes.
Yes.
Okay, perfect. That's great. So first, let me thank you, Ernest, and your team for the kind invitation to participate in the event, and everyone that is attending online for taking time. It is a real pleasure and a privilege for me to share the panel with Anton and Risto. So Anton eventually became a co-author, but early on educated me a lot, not knowingly, just by virtue of me going through his material on these issues. Of course, the usual disclaimer applies. Whatever I say today are my views and not necessarily those of the BIS. Now, I think this presentation is by and large a complement to Anton's. Many of the themes he has discussed in terms of risks and opportunity, we have discussed, in fact, in the joint paper that he mentioned with regards to finance applications. And we have also discussed in the BIS context, in a broader context, also heavily featured in last year's BIS annual economic report chapter on AI, which drew broader implications from AI for the central banking community. And my short remarks today draw from that report, and as such, I will speak mostly to this kind of quote-unquote using AI part of the three roles that Anton was highlighting. So the overall rapid and widespread adoption of AI implies that there is basically an urgent need for central banks to raise their game. And to address these challenges, central banks need to upgrade their capabilities both as informed observers of the effects of technological advancements in general, AI in particular, as well as users of the technology itself. And one important theme that we developed in the annual report is that just as AI poses some important challenges for central banks, it also represents an opportunity. And this is also something that Anton highlighted. So central banks can use AI tools themselves in pursuit of their policy objectives, and also in addressing emerging challenges such as cybersecurity or financial stability considerations. In particular, the use of LLMs and AI can support the central banks in their task of information collection, statistical compilation, macro and financial analysis to support monetary policy, to support supervision, to support the oversight of payment systems, and also in ensuring financial stability. Now, a key application of large language models is nowcasting of economic activity, nowcasting of inflation, and also the monitoring of sentiment analysis for the buildup of risks. So today, nowcasting is done mostly using pre-specified models, and large language models could help overcome this narrow scope of previous nowcasting models because they are versatile, so-called zero-shot learners. The GenAI models can provide forecasts or nowcasts without any fine-tuning. Moreover, by adding non-standard data such as satellite images, text from social media, and so on, they could provide some additional context for the numerical time series data. And then the AI model could then further be refined and trained for the nowcasting exercise. Now, just as large language models are trained to guess the next word in a sentence using a humongous database of textual information, macroeconomic forecasting or nowcasting using GenAI models could also use the same techniques to forecast basically the same numerical observation of an economic variable. And since we published the report, in fact, there has been some work on this front within the BIS and also the central banking community at large. I have myself one paper on this. But perhaps more than in nowcasting, it is in payments and the payment system where AI holds the greatest potential. This is because money laundering networks typically exploit the very large complexity of interconnections across firms, both within and across borders, to basically obscure the nature of their financial transaction, their illicit financial transactions. AI can, in principle, improve the detection of money laundering networks, and this is illustrated by Project Aurora from the BIS Innovation Hub. So this project uses simulated data on money laundering activities to compare the performance of various machine learning tools with the performance of the prevailing rule-based approach that is typically used for detection of money laundering activities in payment networks. The comparison is done under three scenarios. So first, there is a scenario whereby transaction data are siloed at the bank level. Second, there is a national level pooling of the data, so aggregating across banks within a single jurisdiction. And the third scenario is cross-border data aggregation, which compares, which combines data from different jurisdictions using privacy-preserving technologies that do not reveal the underlying data to the authorities in other jurisdictions, which of course is a foremost concern for anyone dealing with this kind of data. Now, the results show that machine learning methods tend to outperform traditional rule-based methods that are prevalent in most jurisdictions for this type of AML activities. This slide shows the comparison when the data are siloed at the bank level. So the first scenario I was mentioning in the previous slide. Now, the pooling of data at the national level gives a further boost to the performance of the machine learning methods, and we can see this in the blue bars on the slide. But the most striking thing is that machine learning methods also excel, particularly when the data from the different jurisdictions are shared in a privacy-preserving way. This is what we show in the yellow bars in the slide. We show the data cooperation improves detection quite dramatically for graph neural networks over current methods, with detection rates going from around 17 to 79%. Now, there are, of course, also risks arising from AI. Anton mentioned some of them. I would like to just hone in on two. Where the first is financial stability. The idea being that the reliance on the same handful of algorithms could amplify procyclicality, could amplify market volatility by exacerbating herding, by exacerbating liquidity hoarding, increasing the probability of runs, and increasing the probability of fire sale scenarios. But again, AI could also be used for a more effective financial stability monitoring and could also help in building early warning indicators that alert supervisors to emerging pressure points that are known to be associated with system-wide risk. So the idea here would be to construct something that is akin to what some of you may know from the literature on early warning indicators of systemic banking crisis, to which also the BIS has contributed early on through the work of Claudio Borio and Matthias Drehmann. I have myself a recent paper on this where we basically use machine learning tools to show that they can better forecast tails of the distribution of market condition indicators. So think like something similar to financial condition indices, and they outperform standard forecasting methods on this regard. Now, a second risk is, of course, the greater prevalence of cyber attacks, which is also a major concern for the central banking community, of course. So we have, more sophisticated versions of familiar tricks are being enhanced, quote unquote, through AI. This includes, phishing, but they could also be entirely new sources of cyber risk that exploit weaknesses that are specific to LLMs to make the model behave in unintended ways or to reveal sensitive information. Here, the canonical example is the so-called grandma jailbreak case. But here again, just as AI increases cyber risk, it can also be used by cyber defenders in both in their threat analysis and also in the monitoring of computer networks. So we ran a survey of central bank cyber experts sometime early last year. And in that survey, most central banks actually deemed AI to be effective or moderately effective at combating cyber attacks, and they were generally more positive in terms of the net effect of AI as regards cybersecurity. In particular, these experts that we survey believe that AI systems can outperform traditional methods in cybersecurity management, especially in areas such as the automation of routine tasks or threat detection. It has to be said, of course, that there are important human capital challenges that come with upskilling the labor force within the central banking community as regards AI. This is also a point that Anton mentioned towards the end of his presentation. It's something that came up very clearly in the survey we conducted last year. So what should be then the next steps for central banks as they continue to address the challenges of AI? Well, top of this list is central banks' role in collecting and using data. So traditionally, most data were collected and hosted within statistical agencies. And also public institutions have traditionally acted as data providers to private sector firms and to the general public. However, with the rise of AI, central banks will be increasingly relying on unstructured data, with more and more of this data being collected by autonomous agents, as Anton was highlighting. But much of this unstructured data reside in the hands of the private sector, which acts increasingly as a data provider. So one important question is how much central banks could rely on in-house data and how much they could source externally. And this is the key factor in central banks' investment in information technology and also investment in human capital. And the bottom line of this, which also goes to the coordination point that Anton mentioned in closing, is that to address these challenges, cooperation among central banks will play an increasingly important role. For one, as you know, the example of Aurora shows in the context of AML, the pooling of resources and knowledge can help mitigate resource constraints, which are very real, and thereby also help lower the barriers for central banks in using AI tools. Central banks, for example, could benefit from sharing domain-adapted or fine-tuned models. And the conclusion of the chapter was that central banks need to come together and foster a quote-unquote community of practice in terms of artificial intelligence, whereby they can share knowledge, data, best practices, AI tools, and so on and so forth. And of course, I should add that as always, the BIS always stands ready to play this part and support our shareholders, central banks, in this effort. So let me stop there and pass it back to you, Ernest, and I look forward to Risto's.
Thank you very much, Inaki. I understand that we lost Risto for a moment, so let's weave in one or two questions from the chat. There's one question by Con Keating. Aren't there more basic concerns about AI? If you look at today's Washington Post tech brief, which suggests a pathetic level of financial competence of the major models. So maybe Anton can say something on this. And then Fabian Bichelmeier asks to all speakers, what are the main factors driving the huge difference between the estimated effects on growth in the various studies, Acemoglu versus Bailey et al.? And maybe if I can add to that growth question, what type of growth are we talking about in in the various AI scenarios. How resource incentive are these growth forms? Is it really the typical kind of service driven growth with little resources, or is it very energy intensive and actually resource intensive? And how sustainable, how would sustainability be affected by these types of growth? So maybe let's start with the financial incompetence, the alleged financial incompetence of major models, and then turn to the growth question. Anton, we cannot hear. Yes.
I haven't seen the Washington Post article on the topic, but I should also say I don't think like the basic LLMs, like we can access them in chatbots nowadays, should be seen as essentially a substitute for financial advisors. They are kind of like, let's say, somebody who has just graduated from a general education but hasn't gotten any specific training on financial advice. And it would be a bad idea to let them loose on people with financial advice. Now, having said that, I could well imagine that in the future, we will take a model like that, specifically fine-tune it to give better advice, and that may be something useful. But I don't know the details of the article. On the growth measurements and estimates, the way that this is typically done is essentially by something called Halden's theorem, which is a first order approximation. Intuitively, it works like that. If you expect that, let's say, half of our workforce is going to become 20% more productive because of generative AI, then you multiply 0.5, which is half of the workforce, times 0.2, which is 20%, times the labor share, which is about 2/3, and you get some sort of estimate like growth is going to increase by 6.666%. So that would be the standard mechanism of estimating the productivity effects of new technologies. Now, why do people differ so starkly in their predictions? First, I think I looked specifically at Ashimoglu's estimates, and compared to my own experience and my best understanding from all the micro studies I've seen, he's really lowballing the productivity effects that AI systems can achieve. And he's putting very conservative estimates on what fraction of the economy will this be relevant for and how much will they gain. Now, if you take a more optimistic perspective on that, then you can plausibly get to the kind of numbers of 1 to 2% that I mentioned per year. Back to you, Ernest.
Thank you. Inaki, do you want to add anything on that?
Yeah, I mean, on the growth, I very much agree with what Anton said, and agree also with the previous answer. What I could add on the growth is that it seemed to me, or I seem to recall when reading. So there was a bit of a debate going on between the Goldman Sachs people and Darren, right, in terms of their estimates. And the Goldman Sachs people provided a nice rejoinder where they went in detail over some of the assumptions. And on top of this lowballing that Anton was mentioning, I seem to recall that there was a strong assumption that certain parts of the labor force would not be affected at all, and there would there would also not be any new industries or any new activities that are going to be generated by AI going forward, which seemed to be an assumption also of the Goldman Sachs people, which is reasonably grounded on what we know from general purpose technologies. And there is this nice quote from the paper by David Autor, which came recently, I think it was in Econometrica, that's something like, I don't know, 60% of the jobs that are being done today were like non-existent 80 years ago or something like that. So the way many of these technologies operate is that they create stuff that was not there before. True, they kill, quote unquote, some occupations, but they also generate many others, and that might also be a reason behind the different the difference in the estimates. And in terms of your question, Anas, on what type of growth, I tend to think of this along the lines of what Anton mentioned earlier on in his presentation, as a general purpose technology that is likely to operate faster than previous general purpose technologies. But at the end of the day, it's kind of an aggregate TFP shock, if you wish. But then it will affect sectors differently because the exposure of the different sectors, depending on the prevalence of AI within the occupations in those sectors, is going to be different as well. So that speaks to the value of having kind of a multi-sectoral approach to evaluating the effects of AI.
Excellent, many thanks. Let me now give a warm welcome to Risto Uuk. I'm happy that you made it. Risto, as I mentioned, is head of EU policy and research at the Future of Life Institute and KU Leuven, among many other functions. Risto, over to you. I understand you share the slides yourself.
Yeah, my name is Risto Uuk. I work at the Future of Life Institute. I'm currently based in Stanford, working at the Stanford Digital Economy Lab as a visiting researcher. And yeah, happy to share my thoughts on the G7 report and related topics. I will focus on two specific parts, which are two specific kind of aspects of the report which relate to artificial general intelligence and systemic risks from AI. And Anton Korinek already gave a really good overview of the progress in AI capabilities, but I wanted to also reiterate that. So here's a graph from Our World in Data showing test scores of AI systems and various capabilities relative to human performance. And we can see that over the last few years, in many different domains, different areas or skills, AI has improved very significantly in reading comprehension, image recognition, language understanding, general knowledge test, math problem solving, code generation. And this particular graph only shows the trends or the progress up until 2023, but already in 24, now 25, there's been a lot more progress. I have to caveat that I'm generally quite skeptical of different benchmarks. It's easy to game them. There are strong incentives for companies to game them and try to, in particular, aim for progress in those benchmarks. That said, I think it's undeniable that over the last few years, there's been a lot of progress in AI capabilities. And some people think that the progress has been so significant that even AGI could be coming, artificial general intelligence. And one definition that companies give to AGI is AI that is able to do nearly all economic tasks better than humans. And one of the leading computer scientists, Yoshua Bengio, is often asked his timeline for when AGI might be coming. And I find his answer very good because it's humble. He has sometimes said something like this. I quote one of his talks, or a quote from one of his talks. Honestly, it could be a few years, like Dario Amodei and Sam Altman are saying, or it could be decades. We need to plan for all of these scenarios because nobody has a real crystal ball. And if people in the audience don't know who Dario Amodei and Sam Altman are, these are the founders of leading AI companies who think that they're very close to developing AGI. And I want to be humble, similar to Yoshua Bengio. I don't know what will happen. It's very hard to predict technological advancement and progress. It could be a few years, it could be longer, there could be bottlenecks, but I think we need to consider the real possibility that it could come very, very soon. And if it does come very soon, it could pose very serious systemic risks. And the G7 report mentions systemic risks and mentions that when AI approaches or achieves AGI, the implications for labor markets and inequality could be particularly stark. AI systems matching or exceeding human capabilities across virtually all cognitive and physical tasks that could really change the role of human labor in the economy and potentially lead to widespread displacement of workers across all skill levels. as machines become perfect substitutes for human labor. And I think actually these risks could be much more than the labor or financial market risks. So in the European Union, the European Commission and other EU institutions have been working on a legal framework for dealing with systemic risks from general purpose AI and in the future artificial general intelligence. And they highlight more risks than risks to the labor market, financial market. They mention things like loss of control, chemical, biological, radiological, nuclear risks, harmful manipulation, risk to critical infrastructure, risk to fundamental rights, to the environment, non-human welfare, democratic processes. There are many, many other risks that AGI could have an impact on the whole society beyond labor and financial markets. And on this slide, I have an argument for why large-scale automation from AI and AGI in particular, because AGI is the ultimate replacement technology as it's envisioned, could pose systemic risks. First premise is that currently there's a momentum toward widespread AI adoption into critical sectors and systems, financial sector, healthcare, infrastructure. Human managed society has already increased large risks, nuclear war, climate change, pandemics, other risks. AI managed society may have even higher risks due to autonomous decision errors, vulnerabilities and unintended consequences, high centralization and connectivity, and these combined AI failures could amplify even to systemic risk level. Therefore, AI could pose systemic risks through integration into critical systems where consequences could be very severe. And I think there are some hints already. The report mentions the 2010 US stock market flash crash, where automated trading algorithms malfunctioned for only 36 minutes, and that led to 1 trillion being wiped off the stock market. But there have been more recent incidents, like the 2024 CrowdStrike IT outage. So the American cybersecurity company CrowdStrike, they distributed a faulty update to their security software that caused widespread problems with Microsoft Windows computers running the software. And this is not an AI incident per se, but arguably software is more controllable than AI. And if we deploy AI in a lot of sectors, critical sectors, then these kinds of incidents could be even more severe. But I think AGI isn't inevitable. A lot of companies, they're saying things like, well, the genie is out of the bottle. We can't stop development. We can only direct it. But AGI isn't gravity. Only a few people in a few companies are creating and leading this race. They could come together, they could coordinate, they could agree to choose a different direction. And there are historical examples of societies prohibiting or restricting certain technologies and economic activities. Like nuclear weapons. Only a handful of countries have nuclear weapons, despite decades and decades into that technology already. Human cloning, widely illegal. Global COVID-19 showed that almost the whole globe implemented lockdowns. And CRISPR technology, while extremely powerful and has a lot of promise, there are ethical implications, and society is taking, in my view, it more cautiously, the use of it. I think there are many alternative pathways. We don't have to develop AGI. There are other things we could do. Here on this slide, I took a look at a lot of different news sources and how much AI-related terms have been used in the last month. And you can see on the slide that agentic AI, AGI, powerful AI, artificial superintelligence, these kinds of terms are discussed a lot in media. But there are other terms that have been discussed as well. Ethical AI, explainable AI, trustworthy AI, human-centered AI, tool AI, transformative AI, a lot of other options. And I think we as a society should have discussions beyond AGI and agentic AI. We should consider other approaches, which could be more promising. I stole a visualization from Future of Life Institute's executive director, Professor Anton Korinek, who has been working on a different pathway, which he calls tool AI. And here, this visualization shows that AGI could be thought as a combination of high autonomy, high generality, and high intelligence. And that in combination potentially being the most risky type of AI. But instead of going for that, we could develop tool AI, which would be more controllable, more understandable, more limited as well, but still very capable, very useful for society. For example, we could develop narrow science tools that have high intelligence, but are not autonomous. We could continue building passive LLMs that don't have high autonomy, but are very capable. They have high intelligence and high generality. You know, household robots, autonomous factory machines, many different options, just not combining all of these capabilities and ramping it up to a very high level across all economic tasks. So what should we do? In the European Union, the Commission released the AI Continent Action Plan just recently. And in line with the Draghi report, the aim of this strategy is to target the key European industrial sectors where the EU has a strong leadership. I think this is the right approach. The EU can focus on manufacturing, energy, environment, mobility, pharmaceuticals, robotics, a lot of very important areas, and targeting them and developing AI in those sectors where we clearly see the need. We don't need to build some kind of AI system that does everything. We can focus on specific things that we want to develop and want to use. And there are many AI innovations happening in the EU along these lines, along the lines of tool AI. For example, in Denmark, there's a company offering AI-powered nurse assistant system that aims to reduce patient falls. In Estonia, there's a company that is aiming to beat financial crime using AI that helps detect money laundering. In the Netherlands, AI systems are used to empower physicians to deliver better patient care. In Finland, the use of AI to provide data-driven decision support for customers for example, in natural catastrophe response and recovery. In Germany, there's a company that turns biomedical data into insights for biopharma. In Spain, there's an AI-powered climate risk intelligence platform to predict natural hazards. There are many, many AI developments and deployments happening in the EU, and I think all of us should invest into those. We should support that kind of AI development as a very strong, powerful alternative to AGI that only a handful of companies, especially in the US, are developing. So if you're interested in how the EU is currently developing the EU AI Act legislative framework and how they're trying to reduce systemic risks from general purpose AI and AGI, you can take a look at my bi-weekly newsletter, the EU AI Act newsletter. Hopefully that helps.
Thank you very much, Risto, for these important thoughts. I think it would be most useful if Anton and Inaki could directly respond in particular to your proposal for alternative approaches to AGI. So to put it in different words, can we plausibly limit AI development? Should we limit AI development? Can we plausibly limit it, given in particular the negative experience with international coordination recently on climate and on trade? So, to achieve such a thing, you need an international consensus that nobody just, takes the lead and uses the others stopping of that. So what's your take on this, Anton and Inaki?
I'll say two things. First of all, I think that the risks, well, first of all, let me divide two things. I think we need to distinguish between the type of AI systems that we have today and that we interact with when we open up ChatGPT or Claude, and the type of AI systems that Risto is concerned about, which is systems that can act autonomously and basically perpetrate a lot of damage, that can do damage to not just a very small, but potentially something that affects humanity as a whole. And I think that concern is right. And I think we need to kind of draw the boundary between the systems we have today that are highly useful and whose diffusion and adoption I think we actually should encourage, and those highly autonomous and risky systems which deserve a very different treatment. Now, can we do something, or will one automatically lead to the other in the future? I think it depends on a range of things. One of them, how fast progress is going to be. If this is all going to happen in the next 2 years, I think this is going to be so fast that it's going to be really difficult. On the other hand, if it will indeed take, a decade or more, then I think it would be easier to engage in the necessary degree of coordination to do something about it. If it's a really fast timeline, then I think our best hope is that the players that are developing and deploying this technology will engage in some responsible degree of self-regulation.
Iñaki, any take on that?
Yeah, I mean, I generally agree with what Anton said on the specific questions. So, like, can we plausibly limit AI? I think no. To me, that's a clear. So I think the horse is out of the barn, so to speak. And whether we should we or can we? I mean, I think this goes back to the coordination issue. You mentioned that, in light of some coordination failures with regards to, for example, climate change containment, where that's a sort of a bad omen for whether we can. But I think we most definitely should and not give up on coordination. I don't think this can be arranged as a tool that is useful for society if there is no such coordination on these kind of issues, especially kind of the tail events that Risto and Anton were pointing towards. And there are examples of previous coordinations on international cooperation on issues that have been long-standing, and I think that should be the blueprint for coordination on AI tools that are highly autonomous and potentially destructive, for example, in either physically or destructive of the fabric of society. To me, coordination is of the utmost priority, I would say. And granted, it's becoming harder, but that's no reason not to pursue it.
Thank you. I mean, this coordination, and it, of course, it stands contrary to the notion of stiff competition among the big AI firms that is currently happening, and to many people, this also seems to be a competition among nations or among big powers for dominance in the AI sphere. Now, we have two questions relating to labor in the chat, by Konrad Richter and by Björn Segendorf. Konrad asks, given the effect of AI on growth and wages, this would mean that most consumers break away because they don't earn wages anymore. How could such an economy function? Is it thinkable that the economy shifts towards a non-human economy where wealth is only transferred between machines? Well, I would then add between the owners of the machines. That's because they are owned by somebody. And then the other question by Björn Segendorf, adding to the question, could collapsing wages and strong productivity growth lead to a prolonged period of deflation, something which we typically want to avoid? I would then add to this question, is this negative deflation? The BIS has a long tradition of positive versus negative deflation. If it's supply side driven, then it's not necessarily negative. And I want to link this to a phrase that I think you, Anton, had in your slides. You called it the end of the age of labor. And that one requires a new social contract. Now, maybe you could speculate what kind of new contract that might be, where the income would come from to people, where the state would get its revenue, and so on and so on. I mean, these are very fundamental questions. We cannot do justice to them, but just, you know, your quick thoughts on that. So maybe we start in the reverse order, starting with Risto, then Iñaki, and then Anton, you can conclude and have the final word.
Yeah, I don't obviously know what this new regime should be. It's very hard to imagine anything being as powerful as the option that right now most people have is to offer their skills on the labor market. That's a very powerful tool of negotiation and bargaining power and whatnot. And considering a world where we don't have that, well, one option obviously that has been thought of would be universal basic income. Everybody would have enough resources that we gain from an automated economy. But I think arguably that is also giving away a lot of power. Like, what if the government one day, doesn't give you basic income, or there's some kind of conflict between those who are developing these technologies and those who want to benefit from it. So what should we do then? Also, right now it looks like we are not preparing societies very much to, take use of universal basic income. There are a few experiments here and there, but arguably under certain scenarios like AGI being developed in a couple of years, those experiments are currently pursued very slowly, and it takes a lot of time to carry those experiments out and implement across the US, across developing countries, across the EU, everywhere. So I'm quite skeptical of UBI working, and people are also skeptical because it can be very expensive. UBI is very expensive. So that's why, though it's very difficult to see, like Anton also mentioned, and other panelists, it's very hard to see the right level of coordination internationally. I don't think we have another approach. I think we should slow down this development. We should be cautious about it, use alternative pathways. I think that's better in the short run than pursuing AGI extremely quickly and hoping that universal basic income saves us. I'm skeptical of that.
Thank you very much, Risto. Iñaki, what's your take on these questions?
I was going to mention the UBI issue as well as a natural counterpart for I would say, like, dramatic future whereby there is no labor anymore and everything is done by machines, and therefore there is no more wage income. I am generally more skeptical of the prospects for AGI. So this kind of tail scenario planning is not something that I have engaged with in as much rigor as probably Risto and Anton have done. I mean, I know Anton has done this in a few of his papers because early on he presented one of those here. I mean, I think that there certainly is that risk, and this could lead collapse in wages, collapse in productivity, and this lead to deflation. I don't think I cannot conceive of a way or a scenario where this would be, as a positive deflation, even if such thing would exist. Because the background or the backdrop against which this would happen would be quite dramatic from a societal perspective. So I think it would be very hard to cast this in any positive light. In terms of these tail risk scenarios, I think probably Anton is better placed to actually engage more thoughtfully with them because he has tackled this in many of his papers.
Thank you, Iñaki. Anton, final words for you.
Yeah, I would say that the concerns that Conrad and Björn expressed are definitely justified, especially if we are on a rapid AGI timeline, which, as we discussed, nobody can be certain about. But ultimately, it depends on what we allow to happen. So, for example, if the tool AIs that Risto described are what will be most prevalent in 3 years or 5 years or 10 years, then I could well imagine that we all have these superhuman tools and labor is actually be more valuable than it is now. But that's by no means a guarantee. So what should we do if the rapid AGI timelines that are predicted by the frontier labs right now will actually materialize? Well, I want to step back and I want to observe that if that is true, economic growth will increase by an order of magnitude. We'll have so much output, and it would be a tremendous public policy, economic policy failure if in this world of abundance like we've never seen before, we have large fractions of the population that become poorer and lose out from this. So I think, and that's my hope, we would need to take just a tiny bit of the additional output generated by AGI and distribute that. And everybody could be bought better off. We could achieve a Pareto improvement. And how exactly we do that is going to be definitely challenging. But I will conclude by citing Elon Musk, who has said relatively recently, we don't want a universal basic income, but we want universal high income. And his belief and hope is that AI will enable us to get there. And I very much hope that he'll be right. Over to you, Ernest.
Thank you very much. I think we have exhausted our time budget. You have really packed a rich set of content into our 75 minutes. Thank you very much. This concludes our SUERF-BAFFI Bocconi lecture on artificial intelligence and economic and financial policymaking. I think it has become clear that many questions are open, that we need to think in terms of scenarios. There is high uncertainty. And in this sense, I'm also sure that we will soon have to meet again in some form or another to see in half a year or in a year where we stand with developments, because since the last event that we had together with Anton, things have moved quite rapidly. A great thank you to Anton, Inaki, and Risto for making it today, despite the technical challenges that you had to cope with, Risto. Much appreciated. Thanks for your presentations and for the discussion, and to all of you for your interest and your questions and comments. Bye-bye and take care.
Thank you.
Thank you. Bye-bye.